Welcome to Talk Tickers, everybody. We're going to be diving deep into JetBlue's Q4 2024 earnings call. And let me tell you, there's a lot to unpack here.
Yeah, I think what's so interesting about JetBlue this year is they're almost like a microcosm of the entire airline industry right now. They're facing, some pretty significant headwinds, but they're also finding these, kind of unique opportunities that could really, completely change the way we fly.
Okay, so let's start with the big picture. JetBlue actually managed to eke out a positive adjusted operating margin of 0.8% for the fourth quarter.
Mm-hmm.
And that's a pretty decent jump, like over 2 percentage points higher than what they saw in 2023.
Yeah, and that's a really crucial point because it shows that their JetForward plan, which they launched, back in July of 2024 to really try to address those profitability concerns, is actually starting to, bear some fruit.
And get this, they absolutely crushed their revenue targets.
Yeah.
Like they exceeded them by a whopping $95 million. And that's thanks to some pretty clever moves, like, tweaking their baggage policies and rolling out some new premium seating options.
Yeah, it really speaks to their agility and adapting to the changing demands of passengers and kind of finding those creative ways to boost revenue. But of course, it's not all sunshine and rainbows. They are facing a pretty massive hurdle with those Pratt Whitney engine groundings, which are predicted to hit their operating margin by a pretty painful 3 percentage points in 2025.
Ouch. Yeah, those grounded planes are definitely going to leave a mark.
Absolutely, yeah. But, JetBlue isn't just sitting back and taking it. They've already set in motion a pretty comprehensive multi-year investment plan to really try to improve their operational reliability. And this has already led to a pretty impressive 6-point jump in their on-time performance.
And almost a 10-point boost to their net promoter score, which is huge EE when it comes to keeping those customers happy.
Exactly, yeah. They're making some noticeable improvements to the whole customer experience, which is absolutely essential in such a competitive industry. But the real question that's on everyone's mind is, can they keep this momentum going? Can they actually hit their pretty ambitious goal of a full year positive adjusted operating margin in 2025? I guess to really answer that, we need to kind of dive deeper into the numbers.
Let's do it. So breaking down their Q4 performance, they actually managed to exceed expectations across all their key metrics, ending up with an adjusted operating income of $18 million.
Yeah, and it's particularly interesting to see how they handled that holiday rush. They managed to navigate those weather disruptions and those ongoing air traffic control challenges really effectively.
Yeah, their completion factor reached an impressive 99%, and their on-time performance actually saw a 5-point increase year over year. And considering the increased air traffic control programs they were dealing with, those are some pretty solid improvements.
Yeah, and this heightened operational efficiency also had a positive impact on their fourth quarter CSM ex-fuel growth. So that means their costs per available seat mile, excluding fuel expenses, actually came in better than they initially anticipated. And that's a key indicator of how well they're managing those day-to-day operations.
Now, switching gears to revenue, they actually surpassed their revised guidance midpoint by a solid 1.4 points.
Yeah, and their strategic initiatives, particularly those revised baggage policies for Blue Basic and the introduction of those preferred seating options, really played a major role in that overperformance.
Those changes generated a remarkable $395 million in revenue for the entire year, blowing past their target by $95 million.
Yeah, and what's really fascinating here is that this revenue capture was initially projected for 2025.
Yeah.
So it really highlights how much faster they're progressing than anyone expected.
That early success has already contributed a cool $90 million towards their ambitious goal of reaching $800 to $900 million in incremental EBIT by 2027. So it seems like they're well on their way to achieving those financial targets, especially after that strong finish in 2024.
Yeah, their 2024 operating margin definitely exceeded expectations, ending up 3.5 points higher than their guidance back in July.
That's a clear testament to their effective cost management and all of those operational improvements they've been implementing.
Yeah, now let's shift our focus to their outlook for 2025.
Okay, so they're projecting a full year positive adjusted operating margin somewhere between 0% and 1%.
Right, and that aligns perfectly with the goal that they set back when they first launched JetForward.
Reaching profitability in 2025 would be a huge milestone for them, wouldn't it?
Absolutely, yeah. However, they're also, they're being realistic about the fact that there's still work to be done, especially when it comes to closing the gap between their performance and that of their industry peers. And of course, we can't forget about that elephant in the room, those pesky Pratt and Whitney engine groundings. They continue to be a major obstacle on their path to success.
Yeah, it's like this constant shadow looming over their future.
Absolutely, yeah. They're estimating that those groundings will unfortunately chip away about 3 percentage points from their 2025 operating margin.
That's a significant hit they'll need to find a way to counterbalance.
Yeah, but they're not just sitting idly by. They're actively working on a number of growth and cost optimization strategies to try to lessen that impact.
And they're really doubling down on improving that operational reliability and customer satisfaction.
Well, exactly, yeah.
Yeah.
So, for example, they're investing heavily in their system operations center, and enhancing their technical dispatch reliability to really try to minimize those controllable cancellations.
So it's all about creating a smoother, more enjoyable travel experience for their passengers.
Exactly, yeah. Happy customers are more likely to come back, right?
That makes sense.
Okay, so now let's take a closer look at their Q4 revenue performance. Their unit revenue actually saw a decent increase, 3.2% year over year, even with a 5% reduction in capacity.
That's pretty impressive. How do they manage that?
Well, a lot of it had to do with some pretty strong close-in demand during those peak holiday periods in November and December. That really contributed significantly to that growth.
So people were still eager to travel, despite all the talk of economic uncertainty.
It seems so, yeah. And they also saw, some healthy unit revenue improvements across, various geographical regions.
That's interesting. Were there any standout areas?
Yeah, their transatlantic routes continued to mature, especially as they went through their first winter with a more seasonally adjusted schedule. Seems like that tweak is paying off.
Smart move. Yeah. What about their other routes?
Well, they actually witnessed a pretty nice rebound in their Latin leisure and VFR markets in the second half of 2024. And VFR stands for visiting friends and relatives, by the way.
Ah, okay. So those more personal travel segments picked up some steam.
Exactly.
Yeah.
Yeah. And as the growth of competitive capacity slowed down, their unit revenues in those markets really started to gain some strength.
So they were able to kind of capitalize on less competition in those areas.
Right. Yeah, makes sense. Their Transcon franchise, particularly their Mint Premium cabin service, also put on a pretty good show.
Their Mint service, yeah, I've heard good things about that. Seems like travelers are really responding positively to those higher end offerings.
Yeah, they are. Unit revenues for both Mint and even more space seats were up in the high single digits year over year in the fourth quarter.
That's a clear sign that their focus on that premium leisure segment is a winning strategy.
Yeah, and the success of their preferred seating options just further reinforces that trend. It's all about, catering to the evolving desires of travelers who are looking for that extra comfort and a more enhanced experience.
It's like they're saying, "Hey, we get it. You want to fly in style.
Yeah.
And we're here to make that happen."
Right, exactly. And let's not forget about their loyalty program, TrueBlue. It played a crucial role in boosting revenue growth as well.
Yeah, loyalty programs are always, they're always interesting. I feel like they could really make or break a brand these days.
Oh, definitely. Yeah. TrueBlue now makes up a solid 12% of their total revenue. So it really showcases how much value it brings and how appealing it is to their customers.
So they're building a pretty loyal following even with all the ups and downs in the industry.
Exactly, yeah. Active TrueBlue members increased in the low single digits, while card spend saw a jump in the high single digits year over year.
Those are some promising indicators that they're cultivating a pretty solid customer base for the long haul.
Yeah.
All right, so let's dig into the nitty-gritty of their financial performance a little bit.
Okay, so looking at the full year of 2024, their CSM ex fuel grew by 6.6%, which stayed comfortably within their initial guidance range.
So they managed to kind of keep their costs in check despite all the challenges.
Yeah, they did. They successfully implemented those controllable cost reductions and achieved some real efficiencies driven by that improved reliability. And these efforts really helped to offset some of the headwinds, like the changes in Pratt Whitney compensation accounting and those targeted capacity reductions they had to implement in the second half of the year.
It sounds like they were juggling a lot of moving parts, but still managed to keep things, relatively stable.
Exactly. Yeah.
Hmm.
Now zooming in on the fourth quarter, their unit costs did increase by 11%, but this was still better than what their revised guidance had suggested.
So they managed to outperform even their own adjusted expectations.
Yeah.
Impressive. What was the secret sauce?
Well, it was a combination of factors, really. Those operational efficiencies, the controllable cost reductions, and then some year-end adjustments, all played a part.
So they were being very proactive about managing their finances, which seems to have paid off.
It did, yeah, and they've built up some positive momentum when it comes to managing those controllable costs, which they're hoping to carry forward into 2025.
That's a good sign for their future prospects. But I'm curious, did they mention any potential challenges or areas of concern for the upcoming year?
Well, they did acknowledge that they expect their CSM ex fuel to rise by 5% to 7% in 2025.
That's a pretty significant jump from their 2024 figures. What's driving that increase?
Well, the main culprit is, you guessed it, the impact of that ongoing Pratt & Whitney engine issue. Those grounded aircraft are going to force them to keep their capacity growth flat, and that's inevitably going to increase their operating costs.
So it's like a double whammy. Less revenue coming in and higher expenses going out. Not ideal.
Definitely not, no. And their projections for the first quarter of 2025 aren't much rosier either. They anticipate their CSM ex fuel to be up 8% to 10%.
Wow, that's even higher than their full year estimate. What's causing this spike in the first quarter specifically?
Well, a few things are at play here. They've got those strategic capacity reductions to contend with. They're also lapping against that pilot wage rate step up from 2024, and then they've got some maintenance expenses that are hitting their books in the first quarter.
So like a perfect storm of factors all kind of converging at the same time to put pressure on their costs.
Exactly. Yeah. But they do anticipate that CSMX will start to moderate throughout the year.
Okay, well that's at least a glimmer of hope. What's contributing to that potential moderation?
Well, they're expecting to see the benefits of those ongoing cost transformation efforts and those operational improvements that we talked about earlier really start to kick in as the year progresses.
So they're banking on their long-term strategies to help them navigate those short-term hurdles.
Precisely, yeah. Speaking of cost transformation, let's not forget their ambitious JetForward program. They're aiming for a cool $175 million in savings by 2027.
That's a pretty substantial target. How are they planning to achieve that?
Well, they're leveraging technology to boost both their operational and commercial efficiencies.
So embracing innovation, finding smarter ways to do things.
Exactly, yeah. They're also, refining their planning and sourcing strategies and implementing initiatives to optimize their fuel burn.
It sounds like they're leaving no stone unturned in their quest for cost savings.
They're definitely committed to making every dollar count, yeah. And these multifaceted efforts will be crucial for them to reach those long-term financial goals they've set for themselves.
It's clear they're playing the long game here, but let's face it, financial stability is ultimately about having a healthy balance sheet. What's their current situation looking like?
Well, their top priority right now is crystal clear, achieving sustained operating profitability. That's the key to unlocking future free cash flow and reducing their debt load.
So profitability first, debt reduction second. Makes sense.
Exactly, yeah. And they took a major step towards that goal back in August by raising a hefty $3.2 billion in strategic capital.
That's a significant injection of cash. What impact did that have on their financial standing?
Well, it dramatically strengthened their liquidity position, giving them a pretty comfortable cushion to work with.
So they've got some breathing room to navigate these short-term challenges and invest in their future growth.
Exactly, yeah. They wrapped up 2024 with a healthy $3.9 billion in total liquidity, and that's excluding their undrawn $600 million revolving credit facility.
So they're sitting on a pretty sizable cash reserve.
Yeah.
That should give them the flexibility to make some strategic moves.
Yeah. They're forecasting a capital expenditure of roughly $1.4 billion for 2025, with $270 million of that allocated to the first quarter.
That's a significant chunk of change. Where are they planning to direct these investments?
A large portion of this capex is earmarked for aircraft-related expenses.
So upgrading and expanding their fleet.
Precisely, yeah. This includes funding for their 24 planned aircraft deliveries, extending the lifespan of their A320 fleet, and implementing those domestic first-class cabin upgrades they've been talking about.
So investing in both capacity expansion and enhancing the passenger experience, it's a balancing act for sure.
Yeah, but they're aiming to finish 2025 with a solid liquidity buffer, ensuring their financial stability for the foreseeable future.
It sounds like they're being very strategic about managing their resources and planning for the long haul. Now let's talk about their fleet plan. What are their plans for bringing in new aircraft and phasing out older ones?
Well, they're expecting a total of 24 new aircraft deliveries in 2025.
That's a substantial number.
Well,
What types of aircraft are they adding to their fleet?
well, they're bringing in 20 A220s and 4 A321neos.
So a mix of newer, more fuel-efficient models.
Exactly, yeah. And those additions will definitely help to modernize their fleet and improve their overall fuel efficiency.
And what about their existing fleet? Are there any plans to retire older aircraft?
Well, they've actually been quite proactive about extending the lifespan of their A320 fleet.
Interesting. How are they doing that?
Well, they've utilized a variety of methods, including lease extensions, lease buyouts, and adjustments to their retirement schedules.
So squeezing a bit more life out of those workhorses.
Exactly, yeah. And this will help to offset some of the capacity constraints caused by those pesky Pratt Whitney engine groundings.
A smart move considering the circumstances.
Yeah. They're also planning to retire their remaining E190 aircraft after the summer peak in 2025.
So saying goodbye to those older, less fuel-efficient models.
Precisely, yeah. Those E190s will be fully replaced by the more modern and customer-friendly A220s.
So it's all part of their strategy to enhance their fleet's efficiency and elevate the overall passenger experience.
Exactly, and they're hoping that all of these efforts will culminate in a positive operating margin for the year.
That would be a major win considering the challenges they face.
Absolutely, yeah. They're projecting nearly $300 million in incremental EBIT generated from JetForward by the end of 2025.
That's a big step towards hitting their target of $800 to $900 million by 2027.
Yeah, and despite the hurdles they've encountered, they remain laser focused on surpassing expectations and delivering on their commitments to shareholders, crew members, and passengers alike.
It's clear they're adapting to the ever-changing dynamics of the airline industry and positioning themselves for long-term success.
Yeah. Now, moving on to their balance sheet, their top financial priority remains achieving sustained operating profitability. This will enable them to generate free cash flow and start chipping away at their debt in the future.
So it's all about establishing a solid financial foundation first, and then tackling that debt burden.
Exactly, yeah. And they took a big step in that direction last August when they raised a substantial $3.2 billion in strategic capital.
That's a substantial influx of cash. What impact did that have on their overall financial standing?
Well, it considerably bolstered their liquidity position, giving them a nice cushion to work with.
So they've got some breathing room to navigate those short-term challenges and invest in future growth.
Exactly.
Yeah.
Yeah. They closed out 2024 with with a healthy $3.9 billion in total liquidity, and that's not even counting their untapped $600 million revolving credit facility.
That's a very healthy cash reserve, giving them the flexibility to make some strategic moves.
Yeah, their projected capital expenditure for 2025 is approximately $1.4 billion, with $270 million of that slated for the first quarter.
That's a significant amount of money. Where are they planning to allocate these funds?
Well, a big chunk of that capex will be going towards aircraft-related expenses.
So investing in their fleet.
Precisely. This includes funding for their 24 planned aircraft deliveries, extending the life of their A320 fleet, and those domestic first-class cabin upgrades they've been talking about.
So striking a balance between expanding their capacity and enhancing the passenger experience.
Yeah, but their goal is to end 2025 with a healthy liquidity buffer, which will ensure their financial stability moving forward.
Sounds like they're being very strategic about managing their resources and planning for the long term.
Now let's delve into their fleet plan. They're anticipating 24 new aircraft deliveries in 2025, consisting of 20 A220s and 4 A321neos.
Those are some impressive additions to their fleet.
Yeah, these new aircraft will play a key role in modernizing their fleet and boosting their fuel efficiency.
And what about their existing fleet? Any plans to retire older aircraft?
Well, they've been proactive in extending the life of their A320 fleet through lease extensions, lease buyouts, and adjustments to their aircraft retirement schedule.
So getting a little more mileage out of those reliable workhorses.
Exactly. And this move will help to mitigate some of the capacity limitations stemming from those Pratt and Whitney engine groundings.
A clever strategy given the circumstances.
Yeah, they're also planning to retire their remaining E190 aircraft after the summer peak in 2025.
So phasing out those older, less fuel efficient models.
Precisely. The E190s will be completely replaced by the more modern and passenger friendly A220s.
It's all part of their ongoing effort to enhance their fleet's efficiency and improve the overall travel experience for their customers.
Yeah, their goal is to achieve a positive operating margin by the year's end, which would be a significant accomplishment given the headwinds they've faced.
It would definitely be a testament to their resilience and strategic planning.
They're projecting nearly $300 million in incremental EBIT generated from JetForward by the close of 2025.
That puts them well on their way to achieving their target of $800 to $900 million by 2027.
Yeah, and despite the obstacles they've encountered, JetBlue remains committed to exceeding expectations and fulfilling its commitments to shareholders, crew members, and passengers.
It's evident that they're adapting to the ever-evolving dynamics of the airline industry and setting themselves up for a successful future. So let's unpack their Q4 performance a bit further. They managed to exceed expectations across all their key metrics, delivering an adjusted operating income of $18 million.
Yeah, and their ability to navigate that holiday travel rush with all the weather disruptions and air traffic control challenges was particularly impressive.
Yeah, their completion factor hit a pretty impressive 99%, and their on-time performance saw a 5-point improvement year over year. And considering the increased air traffic control programs they were dealing with, yeah, those are some solid operational improvements.
Yeah, and this enhanced operational efficiency also had a positive impact on their fourth quarter CSM ex-fuel growth, meaning their costs per available seat mile, excluding fuel expenses, actually came in better than anticipated.
That's a good indicator of how well they're managing their day-to-day operations. Now, on the revenue side, they exceeded their revised guidance midpoint by a healthy 1.4 points.
Yeah, and their strategic initiatives, particularly those revised baggage policies for Blue Basic and the introduction of those preferred seating options, played a key role in this overperformance.
Those changes generated an impressive $395 million in revenue for the entire year, exceeding their target by $95 million.
Yeah, and what's even more remarkable is that this revenue capture was initially projected for 2025, highlighting how much faster they're progressing than originally anticipated.
This early success has already contributed $90 million towards their goal of $800 to $900 million in incremental EBIT by 2027. So it seems like they're well on track to achieving those those financial targets, especially after that strong finish in 2024.
Yeah, their 2024 operating margin exceeded expectations, landing 3.5 points higher than their guidance back in July.
That's a testament to their effective cost management and all the operational improvements they've been implementing.
Yeah. Now let's shift our focus to their outlook for 2025.
Okay, so they're projecting a full year positive adjusted operating margin, falling somewhere between 0% and 1%.
Right, and that aligns perfectly with the goal that they laid out when they launched JetForward.
Reaching profitability in 2025 would be a major milestone for them.
Absolutely, yeah. However, they're also being realistic about the fact that there's still room for improvement, especially when it comes to closing the gap between their performance and that of their industry peers. And then there's the elephant in the room, those Pratt Whitney engine groundings. Those continue to be a major obstacle on their path to success.
Yeah, they're casting a shadow over their future.
Yeah, they're estimating that those groundings will shave about 3 percentage points off their 2025 operating margin.
That's a considerable hit that they'll need to counter.
Yeah, but they're not taking this lying down. They're actively pursuing several growth and cost optimization strategies to try to minimize that impact.
They're also focusing on enhancing their operational reliability and customer satisfaction.
Right. For instance, they're investing in their system operations center and bolstering their technical dispatch reliability to reduce those controllable cancellations.
It's all about making the travel experience as smooth and enjoyable as possible for their passengers.
Right. Now let's turn our attention to their Q4 revenue performance. Their unit revenue grew by 3.2% year over year, despite a 5% reduction in capacity.
That's pretty impressive. How did they manage that?
Well, strong close-in demand during those peak holiday periods in November and December played a big role in that growth.
So people were still eager to travel, even with all the talk of economic uncertainty.
It seems that way, yeah. They also saw some healthy unit revenue improvements across various geographical regions.
Were there any standout areas?
Yeah, their transatlantic routes continued to mature, particularly as they navigated their first winter with a more seasonally adjusted schedule. That strategic tweak seems to be paying off.
Smart move. What about their other routes?
Well, they saw a nice rebound in their Latin leisure and VFR, visiting friends and relatives markets in the second half of 2024.
So those more personal travel segments picked up some steam.
Exactly. Yeah. As the growth of competitive capacity slowed down, their unit revenues in those markets really started to gain some strength.
So they were able to kind of capitalize on less competition in those areas.
Right. Yeah. Makes sense. Their Transcon franchise, specifically their Mint Premium cabin service, also performed well.
I've heard good things about their Mint service. It seems like travelers are really responding positively to these higher end offerings.
Yeah, they are. Unit revenues for both Mint and Even More Space seats were up in the high single digits year over year in the fourth quarter.
That's a strong indication that their focus on that premium leisure segment is a winning strategy.
Yeah, and the success of their preferred seating options just further reinforces that trend. It's all about catering to the evolving desires of travelers who are looking for that, that extra comfort and a more enhanced travel experience.
It's like they're saying, "Hey, we get it. You want to fly in style, and we're here to make that happen."
Right, exactly. And we can't forget about their loyalty program, TrueBlue. It played a crucial role in driving revenue growth as well.
Yeah, loyalty programs can be so powerful these days.
Definitely. Yeah. TrueBlue now accounts for a solid 12% of their total revenue. So it really showcases its value and appeal to customers.
So they're cultivating a pretty loyal following, even in a volatile industry.
Precisely. Yeah. Active TrueBlue members increased in the low single digits, while card spend saw a jump in the high single digits year over year.
Those are positive signs that they're building a solid customer base.
Yeah. Now let's take a look at their overall financial performance. Their CSM ex fuel for the full year of 2024 grew by 6.6%, which was within their initial guidance range.
So they managed to keep their costs under control despite all the challenges they faced.
Yeah, they did. They successfully implemented those controllable cost reductions and achieved some efficiencies driven by their improved reliability.
Those efforts really helped to offset challenges like the Pratt and Whitney compensation accounting changes and the targeted capacity reductions they had to implement in the second half of the year.
Exactly. Now if we zero in on the fourth quarter, their unit costs did increase by 11%, but this was still better than their revised guidance.
So they managed to outperform even their own adjusted expectations. That's impressive.
Yeah.
What was the secret sauce?
Well, this outperformance can be attributed to a combination of factors, including operational efficiencies, controllable cost reductions, and some strategic year-end adjustments.
It sounds like they were being very proactive about managing their finances.
They were, and they've built up some positive momentum in managing controllable costs, which they're aiming to carry forward into 2025.
That's a good sign for their future prospects. But did they mention any potential challenges or areas of concern for the upcoming year?
Well, they did acknowledge that they expect their CSM ex-fuel to increase by 5% to 7% in 2025.
That's a noticeable jump from their 2024 figures. What's driving that increase?
Well, the main culprit is as you might have guessed, the impact of that ongoing Pratt and Whitney engine issue. Those grounded aircraft are going to necessitate flat capacity growth, and that will inevitably lead to higher operating costs.
So less revenue coming in and,
Yeah.
and more expenses going out.
Unfortunately, yes, and their projections for the first quarter of 2025 aren't much better. They anticipate their CSM ex-fuel to be up 8% to 10%.
Wow, that's even higher than their full year estimate. What's causing this spike in the first quarter?
Well, a few things are contributing to this projected increase, including strategic capacity reductions, the lapping effect of the 2024 pilot wage rate step up, and the timing of certain maintenance expenses.
So a confluence of factors putting upward pressure on their costs in the first quarter.
Right. However, they do anticipate that CSMX fuel will start to moderate throughout the year.
That's a glimmer of hope. What's driving that projected moderation?
Well, they're expecting to see the benefits of their ongoing cost transformation efforts and those operational improvements we talked about earlier really start to kick in.
So their long-term strategies are expected to help them navigate those short-term challenges.
Exactly. Speaking of cost transformation, let's not forget their ambitious JetForward program. They're targeting $175 million in savings by 2027.
That's quite a target. How are they planning to achieve that?
Well, they're utilizing technology to improve both operational and commercial efficiencies, streamlining their planning and sourcing strategies, and implementing initiatives to optimize their fuel burn.
It sounds like they're leaving no stone unturned in their pursuit of cost savings.
They're definitely committed to making every dollar count, and these multi-pronged efforts will be crucial for them to hit those long-term financial targets they've set for themselves.
It's clear they're in it for the long haul. But
Yeah.
but let's face it, financial stability is about having a healthy balance sheet.
Yeah.
What does their current financial picture look like?
Their top financial priority at the moment is achieving sustained operating profitability. This is what will allow them to generate free cash flow and ultimately chip away at their debt down the road.
So profitability first, debt reduction second. Makes sense.
Exactly. And they made a significant move toward achieving this goal back in August when they raised $3.2 billion in strategic capital.
That's a substantial influx of cash. What impact did that have on their overall financial standing?
Well, it considerably bolstered their liquidity position, giving them a nice cushion to work with.
So they've got some breathing room to navigate these short-term challenges and invest in future growth.
Exactly. They finished 2024 with $3.9 billion in total liquidity, excluding their untapped $600 million revolving credit facility.
That's a very healthy cash reserve, giving them the flexibility to make some strategic moves.
Yeah, their projected capital expenditure for 2025 is approximately $1.4 billion, with $270 million of that allocated to the first quarter.
That's a significant amount of money. Where are they planning to direct these investments?
A large portion of this capital expenditure is earmarked for aircraft-related expenses.
So they're investing in their fleet.
Precisely. This includes funding for their 24 planned aircraft deliveries, extending the life of their A320 fleet and those domestic first-class cabin upgrades they've discussed.
So they're balancing capacity expansion with passenger experience enhancements.
Yeah. Their goal is to end 2025 with a healthy liquidity buffer, which will ensure their financial stability moving forward.
It seems like they're taking a very strategic approach to managing their resources and planning for the long term.
Now let's dive into their fleet plan. They're expecting to take delivery of 24 new aircraft in 2025, including 20 A220s and 4 A321neos.
Those are some impressive additions to their fleet.
Yeah, these new aircraft will be instrumental in modernizing their fleet and improving their fuel efficiency.
And what about their existing fleet? Any plans to retire older aircraft?
They've been proactive in extending the life of their A320 fleet through lease extensions, lease buyouts, and adjustments to their aircraft retirement schedule.
So they're getting a bit more mileage out of those workhorses.
Exactly. And this will help to counterbalance some of the capacity limitations resulting from those Pratt Whitney engine groundings.
A smart move, considering the current situation.
Yeah. They're also planning to retire their remaining E190 aircraft after the summer peak in 2025.
So phasing out those older, less fuel-efficient aircraft.
Precisely. Those E190s will be completely replaced by the more modern and passenger-friendly A220s.
It's all part of their strategy to enhance their fleet efficiency and elevate the overall travel experience for their passengers.
Yeah, their goal is to achieve a positive operating margin by the year's end, which would be a significant achievement considering the challenges they've faced.
It would certainly demonstrate their resilience and strategic planning.
They're projecting nearly $300 million in incremental EBIT generated from JetForward by the close of 2025.
That puts them well on their way to achieving their target of $800 to $900 million by 2027.
Yeah. Despite the obstacles they've encountered, JetBlue remains focused on exceeding expectations and fulfilling its commitments to shareholders, crew members, and passengers.
It's evident that they're adapting to the ever-changing dynamics of the airline industry and setting themselves up for a successful future.
Now let's take a closer look at some of the specifics of their financial performance. Their CSM ex-fuel for the full year of 2024 grew by 6.6%, which fell within their initial guidance range.
Yeah.
So they managed to keep their costs under control despite all the challenges. They did. They successfully implemented controllable cost reductions and achieved efficiencies driven by their improved reliability.
Those efforts were key in offsetting headwinds like the Pratt and Whitney compensation accounting changes and the targeted capacity reductions they implemented in the second half of the year.
Right. Now, if we zero in on the fourth quarter, their unit costs did increase by 11%, but this was still better than their revised guidance.
So they managed to beat their own expectations even after adjusting their projections. That's impressive.
Yeah.
What was the secret sauce?
A combination of factors, really. Those operational efficiencies, the controllable cost reductions, and some strategic year-end adjustments all played a part.
It sounds like they were being very proactive about managing their finances.
They were, and they've built up some positive momentum in managing controllable costs, which they're hoping to carry into 2025.
That's a good sign for their future prospects. However, they did mention that they anticipate their CSM ex-fuel to rise by 5% to 7% in 2025.
That's correct. And the main culprit behind this increase is the impact of the Pratt and Whitney engine issue. Those grounded aircraft are going to necessitate flat capacity growth, and that will inevitably increase their operating costs.
So less revenue coming in and higher expenses going out.
Unfortunately, yes. And their projections for the first quarter of 2025 aren't much better. They anticipate their CSM ex-fuel to be up 8% to 10%.
That's even higher than their full year estimate. What's causing this spike in the first quarter?
Several factors are contributing to this projected increase, including strategic capacity reductions, the lapping effect of the 2024 pilot wage rate step up, and the timing of certain maintenance expenses.
So a confluence of events that are putting upward pressure on their costs in the first quarter?
Right. However, they do anticipate that CSM ex fuel will start to moderate as the year progresses.
That's a bit of good news, at least.
Yeah.
What's driving that projected moderation?
Well, they're expecting to see the benefits of their ongoing cost transformation efforts and those operational improvements we talked about earlier really start to kick in.
So their long-term strategies are expected to kick in and help them navigate those short-term challenges.
Exactly. Speaking of cost transformation, let's not forget their ambitious JetForward program. They're aiming for a cool $175 million in savings by 2027.
That's an ambitious target. How do they plan to achieve those savings?
Well, they're leveraging technology to enhance both operational and commercial efficiencies, streamlining their planning and sourcing strategies, and implementing fuel burn optimization initiatives. It sounds like they're pulling out all the stops in their quest for cost savings.
They're definitely committed to maximizing efficiency. It's clear they're in it for the long haul. But at the end of the day, financial stability is built on a solid balance sheet. What does their current financial picture look like?
Their number one priority right now is crystal clear: achieving sustained operating profitability. That's the key to unlocking future free cash flow and making a dent in their debt down the line.
So profitability first, debt reduction second. Makes sense.
Exactly, and they took a significant step towards that goal back in August when they raised a hefty $3.2 billion in strategic capital. That move really bolstered their liquidity, giving them a much needed cushion.
So they've got some breathing room to weather those short-term storms and invest strategically in future growth.
Absolutely. They wrapped up 2024 with a healthy $3.9 billion in total liquidity. And that doesn't even include their undrawn $600 million revolving credit facility.
That's a pretty substantial cash reserve, giving them a lot of flexibility to make strategic moves.
Yeah. Looking ahead, they're projecting a capital expenditure of roughly $1.4 billion for 2025, with $270 million of that allocated to the first quarter.
That's a significant investment. Where are they planning to allocate these funds?
A sizable portion of that CapEx will be directed towards aircraft-related expenses.
So investing in expanding and upgrading their fleet.
Precisely. This includes covering the costs for their 24 planned aircraft deliveries, extending the lifespan of their existing A320 fleet, and implementing those domestic first-class cabin upgrades they've been talking about.
So they're striking that delicate balance between boosting capacity and enhancing the passenger experience.
Exactly. Their objective is to conclude 2025 with a solid liquidity buffer to ensure their financial stability going forward.
Sounds like they're taking a very strategic and long-term approach to managing their resources. Now let's dive into their fleet plans a bit deeper. They're expecting to take delivery of 24 new aircraft in 2025, which includes 20 A220s and 4 A321eos.
Those are some exciting additions to their fleet.
Definitely. What role will these new aircraft play in their overall strategy?
These new planes are essential for modernizing their fleet and significantly improving their fuel efficiency.
And what about their current fleet? Are there any plans to retire some of the older, less fuel efficient aircraft?
They've actually been quite proactive about extending the life of their existing A320 fleet.
Interesting. How have they managed to do that?
They've used a combination of tactics, including lease extensions, lease buyouts, and adjustments to their aircraft retirement schedule.
So squeezing a bit more life out of those reliable workhorses.
Exactly. It's a smart move considering it helps to offset some of those capacity limitations caused by the Pratt Whitney engine groundings.
Makes sense. So are they retiring any aircraft at all?
Yes, they are planning to retire the remainder of their E190 aircraft after the summer travel rush in 2025.
So saying goodbye to those older, less fuel efficient models.
Precisely. Those E190s will be fully replaced by the more modern and passenger friendly A220s.
It's all part of their ongoing efforts to boost the efficiency of their fleet and elevate the overall travel experience for their customers.
Yeah.
It's clear that they're putting a lot of thought and effort into optimizing their operations and making smart investments for the future.
Absolutely. They're facing their share of challenges, but they're definitely taking proactive steps to mitigate those risks and position themselves for success.
Now let's talk about their long-term goals. They've set their sights on achieving a positive operating margin by the end of 2025, which would be quite an accomplishment considering the headwinds they've encountered.
It would be a real testament to their resilience and strategic planning.
And how are they tracking towards their ambitious target of $800 to $900 million in incremental EBIT by 2027?
They're projecting nearly $300 million in incremental EBIT generated from JetForward by the close of 2025, which puts them well on their way to hitting that target.
Despite the obstacles they've faced, they seem determined to exceed expectations and deliver on their promises to shareholders, crew members, and passengers alike.
They're definitely not shying away from a challenge. They're adapting to the ever-changing landscape of the airline industry and laying the groundwork for a bright future. It's inspiring to see their commitment to both financial performance and customer satisfaction.
It's like they're trying to find that sweet spot where they can excel in both areas.
Yeah.
Now, before we move on to our "This is not financial advice" segment, is there anything else that really stood out to you from this earnings call?
What struck me most was their unwavering optimism, despite the challenges they're facing. You know, they're not letting those Pratt Whitney engine issues define them. They're actively seeking solutions and even viewing it as a potential opportunity for growth in the long run.
That's a really positive outlook. It's refreshing to see a company embracing challenges head on,
Right.
rather than getting bogged down by them. It speaks to their agility and their ability to adapt to unexpected situations.
I agree. Their focus on enhancing the customer experience is also commendable. They're investing in operational reliability and tailoring their offerings to meet the evolving needs of travelers. It's clear that they're prioritizing customer satisfaction alongside their financial goals.
I think that's a key takeaway from this earnings call. They're not just focused on the bottom line. They're committed to creating a positive travel experience for their passengers. And in an industry that's often criticized for prioritizing profits over people, that's a really refreshing approach.
It is. It raises the question, though, can they truly achieve that delicate balance between, financial performance and customer satisfaction?
It's a tough question to answer. It's a tightrope walk for sure, but their commitment to both is evident in their actions and their investments.
Only time will tell if they can successfully navigate this complex landscape and find that sweet spot.
Well, let's shift gears now and dive into our "This is not financial advice" segment. Remember, this is purely hypothetical and just for fun.
Absolutely. Always remember that we're not financial advisors, and this is not a recommendation to buy or sell any securities.
Exactly. We just like to explore some out of the box ideas and see where our imaginations take us. So with that disclaimer out of the way, let's have some fun.
I'm all ears.
All right. So here's my wild but potentially plausible trade idea. What if JetBlue partnered with a major tech company, think Google, Apple, or Microsoft, to offer super fast premium in-flight Wi-Fi?
That's an intriguing concept. It
Yeah.
would certainly be a game changer in the realm of in-flight connectivity.
Right. They could position it as a productivity haven for business travelers,
Yeah.
allowing them to work seamlessly in the air.
It would definitely appeal to the growing trend of remote work and the ever increasing need for reliable connectivity on the go.
Imagine no more of that frustratingly slow Wi-Fi that barely lets you check your email.
Yeah.
Instead, you got a dedicated high-speed connection that lets you video conference, stream content, and work on complex tasks without a hitch.
It would be a huge draw for business travelers, potentially leading to increased demand and the ability to charge higher fares.
Exactly. And with a tech giant on board, they could leverage cutting-edge technology and infrastructure to deliver a truly exceptional Wi-Fi experience, something that sets them apart from the competition.
It would require a significant investment from both parties, but the potential returns could be substantial.
Of course, there would be challenges like ensuring equitable access for all passengers and managing bandwidth allocation.
And cybersecurity would be paramount, especially when dealing with sensitive business data.
True, but I believe those are surmountable challenges. The benefits could outweigh the risks, especially if it gives JetBlue a major competitive advantage.
It's definitely a bold move that could pay off handsomely if executed effectively.
All right, that wraps up our This Is Not Financial Advice segment for today. But it does raise an interesting point about JetBlue's overall strategy. They seem to be very forward-thinking and willing to explore innovative ideas to enhance the passenger experience.
I agree. They're not afraid to think outside the box and push the boundaries of what's possible in the airline industry.
It'll be interesting to see what other innovative initiatives they come up with in the future.
I'm sure they'll continue to surprise us.
Yeah. Now, circling back to JetBlue's overall performance in Q4 2024 and their outlook for 2025, there were a lot of moving pieces to this story.
Absolutely. They're navigating a complex landscape with both opportunities and challenges.
They exceeded expectations in several key areas, but they're also facing some significant headwinds.
Their commitment to operational excellence, cost management, and customer satisfaction is evident.
But the question remains, can they sustain this momentum and achieve their ambitious goals in the face of these challenges?
I guess we'll have to wait and see. But one thing's for sure, it'll be a fascinating journey to follow.
All right, everyone, that concludes our deep dive into JetBlue's Q4 2024 earnings call. We covered a lot of ground today, but as always, there's always more to explore. What stood out to you? What questions are you left with?
We'd love to hear your thoughts, so be sure to connect with us on social media and keep the conversation going.
Until next time, happy investing.